Let me give you a window into what we do here. And Paul Sweeney was instrumental in making this happen. Years ago, I had a beverage of my choice with one of our wonderful founders, the magic Tom Secunda. He says, what if we do something like, securities analysis, bonds, tech, and all that? I said, okay. And it became Bloomberg Intelligence, and Paul built it out for us. It's on the terminal. And it's addictive. It's like really, really narrow, interesting stuff, which is what people worldwide that have a Bloomberg terminal want. The king of this in tech is Robert Schiffman. He publishes almost daily. And basically the message, and to have him here is an honor, the basic message from you is everybody calm down. The world's not going to an end with Capex at tech. How can you sleep at night?
Well, first off, the next time you're going out for a drink, please invite me. My dog's name is Whiskey, so always happy to talk about this after hours.
I like that, yeah.
Listen, I've never been as bullish on big cap tech as I am right now. So I understand some of the fears. Quite frankly, the way I think about it is it's a little bit about perspective. Like if you're looking at a Rorschach test, some people, equity analysts, are very much concerned that valuations are wildly out of whack and all the money that's being spent is never going to be earned back. From a credit perspective, I don't think people are worried at all. And there's data to back that up. IG tech spreads year to date are tighter. Oracle, who probably, I talked about Alphabet this morning being the poster child of Capex. Well, Oracle was the poster child for everything that everyone wanted to beat up on in AI. They did a $25 billion bond deal, and they had a $130 billion order book, and spreads went tighter. There is so much demand for high-grade, high-quality tech bonds right now. I don't see it going away. So the more money they can spend, the better.
So what may have changed a little bit for some investors is in years past when we talked to you about a big tech company coming to market with a bond deal, and it was usually because they can. The market's there. Why not? Now it's a little bit more of they kind of have to. Talk about the Capex they're talking about. It dents the cash they have on the balance sheet. It eats into their free cash flow. They kind of need to come to the capital markets. That's a little bit different discussion. But that's not necessarily reflected into the pricing, is it?
Well, listen, I think you're probably skewing it a little bit more than it really is.
Okay.
They all don't need to. Alphabet right now is sitting on $127 billion of cash. Now, let's say they spend $185 billion in Capex next year, and that's the same amount as their OCF. That's no needs. They've got some M&A, they've got some strategic investments. They would still have $80–90 billion of cash to end the year, even if they didn't borrow anything else. I think the interesting thing is that what you've said in the past to me is, why aren't these companies paying more dividends? You asked Dan this morning, why isn't Microsoft going to go out and buy back a lot more stock?
Yeah.
And first of all, I think that these companies have much different visions than what we have. They can see the future that we can't see. And they're willing to put their money right where that vision is. So that's first.
Okay, I got to frame this. You're out of Cornell. You'd go to Columbia. You started a small firm called Kidder Peabody. Was Julian Robertson there when you were there? Were you like 19 years old?
I was just running spreadsheets in a dark room by myself until midnight, so I don't know who was there.
Okay,
I was just glad
Doug
they
was outside.
paid $4 for my dinner each night.
And then you end up doing credit at DLJ, which is like going to the Vatican. I mean, it's extraordinary. Robert Schiffman, tell me about the behavior of these executives. Are they acting in a normal way? My stock's down X amount. Do a bond issuance and buy back stock? Do they act like industrial companies in their mindset?
Well, think about it in a couple of different ways. One is size and scale. What would the impact of a stock buyback even be? And I think we have to put in perspective the scale of these companies. When we start thinking about these numbers, right? $185 billion in Capex. Your sort of mind sort of blows up. But it's almost like, to me, like talking to my father about going to the movie. And he's like, back in my day, a movie ticket costs a quarter. Well, you know what? Everything costs a lot more these days. These are trillion-dollar market cap companies. $185 billion, yes, it's a lot of money. Is it a lot of money relative to their cash flows? Not really. And certainly versus industrial companies that oftentimes spend a lot more than their cash flows. And what are these companies thinking? Return on invested capital. I hear this all the time. Are they ever going to make their money back? Do you know what the return on invested capital of a share buyback is? It's zero. These companies are going after growth. And then listen, the last thing, because I talk way too much, is just let's look at performance. Let's look at fundamentals. Every single one of these big cap AI hyperscalers are growing at double-digit top-line rates. This is all about perspective. They're not growing as fast as the equity market wants, so valuations come down. I think bonds are actually leading the charge here by saying we are not that concerned.
Worldwide this morning, Robert Schiffman with us with Bloomberg Intelligence. Did you find Schiffman? Were you like one day with 800 resumes on your desk?
Yeah,
and
absolutely.
you said, "Who's this nerd?"
We know. I know this guy.
He's the land of, scattered out. He does scattered out charts like no one.
Exactly.
Paul Sweeney with Robert Schiffman.
Is the market discerning or differentiating some of these tech companies when they do come to the market, or are they just grabbing up everything they can?
Well, the answer is yes, and it really makes much more of a difference as we go down the credit scale. If we're thinking about the Metas, Alphabets, Amazons, Microsofts, not really that much. They trade super tight in a really narrow range. 30, 40-year bonds are trading well inside of 100 basis points over. As you move down to triple Bs, you start looking at the Oracles of the world that are trading more than twice as wide. Wider than the average triple B as well, but not really so much, I think, in very much scared territory. It's really in the high yield market where we're starting to see a lot of weakness. High yield tech is a lot wider yield year to date. You're hearing a lot about busted loans at banks. I think that's where the real fear is, and it does. There is going to be more problems, I think, in the high yield markets. But as we think about the triple B names, all the mega caps and the hyperscalers, that's not where there's a lot of concern, and there's not a lot of discernible difference between any of these name trades, whether it's a semiconductor name like an Intel or a memory play like a Micron.
I want to give a window into what you do for pros. On Oracle a couple days ago, you and your team, high-grade technology 2026 spread movers. All you need to know, folks, is it looks like a Damien Hirst piece of artwork at some modern museum out there. It's like 150 dots on a screen. Robert Schiffman, king of the scatter dots. What's the most interesting scatter dot chart now that gives you confidence in Microsoft, confidence in beleaguered software?
Yeah, actually, if you just look at all of these high-grade names together on that scattered dot plot, if you threw in just a couple of high-yield names, all of the dots in the high-grade universe would look like they're trading on top of each other. And that's what's going back to the level of confidence from AAA to triple B. There really isn't that much fear. I will tell you though, like you asked Dan, I have people coming up to me. My cousin asked me the other day whether or not they should sell their Microsoft stock. So I do think that there's reason to be worried when stocks fall off their high and whether it's not going to fall to bonds. I think we should just go back to the financial crisis. And when we think about what happened with the financial crisis, bonds and CDS led this market a lot lower. In this case, you're not seeing that at all. No. And that's why my confidence is there. And by the way, when you just think about confidence, again, go back to this Oracle deal. People can't get enough of these bonds. We're actually seeing investor demand. I think if we see a Microsoft deal, an Alphabet deal.
How big a deal? What size would Microsoft be?
It could be anything that they want. I actually don't think Microsoft needs any dollars at all.
We know that, but they go like 50 billion, let's do it.
If you're going to come and you're Microsoft and you have a $3+ trillion valuation, doing $5 billion of bonds really doesn't make any difference. I think if they're going to come, it's probably the sort of 10 to 20 odd billion dollar range.
Come on, 50.
They don't need it.
Are there any covenants on these things? There's a covenant, like a page. I mean, they're just coming and you take what we're giving you.
Yeah. Investment grade analysts can't spell covenant, and most high yield analysts can't do that either. There are no covenants. There's no need for covenants.
Okay.
That's the reality. Covenants protect bondholders from a lot of really bad things. There's not a lot of really bad things that go on here. Look at what the rating agencies are doing.
Right.
There's no downgrades out there in the high grade universe. Everything's being affirmed. So you don't have to worry about meaningful step ups in leverage. When you go from a positive cash position, i.e. your cash is greater than your debt, to say a net debt neutral position, it doesn't affect your leverage at all. Negative leverage is fake.
So in April, the president has a Rose Garden soiree on tariffs or whatever. Tim Cook is, people are beating up on him.
Yeah.
China, oh my God, it's going to
Yeah.
fall into the Pacific Ocean. Apple's up $100 on a share price. And there's story after story like this. 2-3 years ago, wasn't Google going to fail? Like search it's going to be.
They were
Did
going
you
to
see
split them up.
Did you see the search numbers yesterday?
Yeah, absolutely.
The YouTube numbers, single-handedly, the YouTube numbers were because of Alexis
Yes,
Christoforous.
exactly.
Thank
They
you very
mentioned that
much.
in the conference call as well. When you see it's Joni Mitchell at the Grammys here the other night, the star-making, profit-making machinery of this thing is what people can't grasp.
Yeah, listen, these companies have either ecosystems or walled gardens blocked off where people can't gain entry, and they are taking advantage of that. And again, you make money by spending money. So listen, Apple's a little bit of an outlier. They don't necessarily need to be a hyperscaler because they have such a deep services and product machine that they can utilize. But listen, look at the numbers. They just look great. They don't match up what the fear is, at least in the equity markets today. And I think the Dan Ives of the world are going to end up looking like superstars in probably 3 or 6 months. There's always these situations, whether like it was a DeepSeek or like the Liberation Day. It creates more
DeepSeek,
opportunity than anything. But in the meantime, everyone's worried about catching a falling knife. I'm just telling you, from the credit perspective, you're not feeling that sort of pressure. Equities are not going to suffer because
Right.
balance sheets are over-levered.
Paul, get one more in here. Schiffman's day doesn't start till 11 a.m.
Exactly right. All right. So from the credit perspective here, is there something that the credit market would get concerned about? I mean, if they start disappointing on maybe the return on investment metrics, is there something that the bond market is looking at?
Yeah, there's a lot of different things. I think the biggest picture is always all-in yields. So you guys talk about rates all the time.
Yep.
Getting Ira here to talk about like the long end, or going a lot higher, or the curve steepening dramatically. So rates and macro issues I think are much more
the
important.
bigger
If we look through earnings right now, generally pretty strong. I actually think we're going to see a much larger wave of issuance over the next month,
Right.
And it's going to be well received.
All right.
Interesting. One final question. Does Alex Reed do all the work, or do you actually put the articles together yourself?
Alex does do all the work.
He does all the work as well.
That's how it works.
This
in
has
research.
been, where are you based? Are you in Princeton? Are you in New York?
I am
Are
now
you-
on the 10th floor upstairs, but they don't let me down for snacks anymore. I just have to keep doing those scatter
They bring
shot
them to
charts.
you. Yeah.
Yeah.
It's
We're allowed to go to the restroom once every 3 days.
Thank you so much. Greatly. You just can't say enough about his work. Robert Schiffman, folks, you say, okay, why do I need a Bloomberg terminal? And Paul and I know, and Mr. Bloomberg knows, all of our research is people have and continue to have a Bloomberg terminal, not because of 47 things, but like 5 things.
Yeah.
To a lot of people, Robert Schiffman is one of those 5 things. They wait every morning to see really pro-level work from Schiffman and Alex Reed here. It's their tech chart pack.
Yep. That's how they do
Did
it.
you come up with that phrase?
No, please. I'm not a numbers guy.
Robert Schiffman, back to the 10th floor. Thank you so much. Absolutely definitive there. We'll feature that, I hope, through the next couple of days. Schiffman there on the debt and the potential debt issuance of these major companies. What are they looking at?